Learning how to start investing as a beginner may seem overwhelming at first, especially with the abundance of options, risks, and financial jargon involved. However, the process is far more approachable than it appears, and understanding the core principles of investing can pave the way toward long-term financial security and wealth building. Investing is the act of allocating money into assets with the goal of generating returns over time. While saving helps you preserve wealth, investing allows your money to grow and outpace inflation. For beginners, the key lies in learning the basics, understanding your personal goals, and applying consistent strategies. With the right mindset and method, anyone, regardless of income level or background, can become a confident investor. The first step to investing as a beginner is to assess your current financial situation. Before you invest, it's important to ensure that you have your financial foundation in place. This means having a steady income, paying down high-interest debt like credit cards, and building an emergency fund that can cover at least 3 to 6 months of living expenses. Investing involves risk, and you want to avoid the possibility of having to sell investments prematurely due to a financial crisis. Once your basic needs and security nets are in place, you're in a much better position to begin investing with confidence and purpose. Understanding your goals and time horizon is the next essential element of investing. What are you investing for? It could be retirement, buying a house, funding education, or simply building wealth. Your time horizon, the length of time before you need the money, directly influences the types of investments that are appropriate for you. Short-term goals, within 5 years, typically require safer, less volatile assets like savings accounts or short-term bonds. Long-term goals, 10 years or more, allow you to invest in higher growth assets like stocks, which may fluctuate in the short term but historically offer greater returns over time. Matching your investments to your goals ensures that your strategy is aligned with your needs and risk tolerance. Speaking of risk tolerance, understanding how much risk you can emotionally and financially handle is a critical part of being a successful investor. Risk tolerance refers to your ability and willingness to endure market fluctuations and potential losses. Some investors are comfortable with high levels of volatility in exchange for potentially higher returns, while others prefer more stable, predictable investments. Knowing your personal risk tolerance helps you choose investments that won't cause panic or impulsive decisions during market downturns. A risk questionnaire or consultation with a financial advisor can help you assess your comfort level and guide your investment choices accordingly. Once you understand your goals and risk tolerance, it's time to choose the type of investment account that's right for you. Beginners often start with tax-advantaged retirement accounts such as a 401k, especially if offered by an employer, or an individual retirement account, IRA. These accounts provide tax benefits that make them ideal for long-term investing. For general-purpose investing, a taxable brokerage account is appropriate. Opening an account with a reputable brokerage firm, either traditional or online, is usually simple and can be done within minutes. Many beginner-friendly platforms offer low fees, user-friendly interfaces, and educational resources to support new investors along the way. The next step is to choose what to invest in. The 3 most common types of investments are stocks, bonds, and mutual funds, or their modern counterpart, exchange-traded funds, or ETFs. Stocks represent ownership in a company and typically offer higher returns but also higher volatility. Bonds are loans to governments or corporations that pay interest over time and are generally more stable. Mutual funds and ETFs pool money from many investors to buy a diversified basket of investments, which helps reduce risk through diversification. For beginners, diversified index funds and ETFs that track the overall market, like the S&P 500, are often the most efficient and least risky way to begin investing. They provide exposure to a wide range of companies with low fees and minimal effort. Dollar-cost averaging is a smart method for beginners to enter the market gradually and minimize the risk of investing all their money at once. This strategy involves investing a fixed amount of money at regular intervals, such as monthly, regardless of market conditions. By doing so, you buy more shares when prices are low and fewer shares when prices are high, which helps reduce the average cost per share over time. This method also builds the habit of consistent investing, which is more effective over the long term than trying to time the market, which is notoriously difficult even for professional investors. Another core principle for beginners is diversification, which means spreading your money across different investments to reduce risk. A diversified portfolio includes a mix of asset classes, such as stocks, bonds, and real estate, and within those classes, different sectors, regions, and industries. Diversification prevents one poor-performing asset from dragging down your entire portfolio. Most beginners achieve diversification through broad-based ETFs or mutual funds, which automatically spread your investment across hundreds or thousands of securities. A well-diversified portfolio provides more stable returns and protects you from the ups and downs of any single investment. Fees are a hidden but significant factor in investing. Many mutual funds, financial advisors, and investment products charge fees that can eat into your returns over time. Beginners should prioritize low-cost investments such as index funds or ETFs with low expense ratios, ideally below 0.20% annually. Additionally, avoid trading excessively or using platforms with high commissions, as these costs compound and erode your wealth. Understanding and minimizing fees is one of the easiest and most impactful ways to boost your long-term investment performance. One of the biggest mental challenges for beginners is managing emotions during market volatility. Markets naturally fluctuate, and it's normal for your investments to go up and down in value. During downturns, the instinct to panic and sell is common, but dangerous. Selling at a loss locks in your losses and prevents you from benefiting from eventual recoveries. Long-term investors must learn to stay calm and avoid emotional decision-making. A good strategy is to avoid checking your investment account too frequently and to remind yourself that investing is a marathon, not a sprint. Staying focused on your long-term goals helps you weather temporary setbacks and stay on track. Rebalancing your portfolio periodically ensures that your investments stay aligned with your risk tolerance and goals. Over time, some investments may grow faster than others, causing your allocation to drift. For example, if stocks perform well, they may represent a larger portion of your portfolio than intended, increasing your risk exposure. Rebalancing involves selling some of the overperforming assets and reinvesting in underrepresented ones to restore your original balance. Doing this annually or semi-annually helps maintain your strategy and avoid unintended risk. Investing is not a set-it-and-forget-it process. Continuing education and periodic review of your goals and portfolio are essential. As your life changes, getting a new job, buying a home, starting a family, your financial goals may shift. Revisit your investment strategy regularly to make sure it still aligns with your evolving needs. There are countless books, podcasts, and courses available that can deepen your knowledge of investing and help you make more informed decisions. The more you learn, the more confident and capable you become as an investor. It's also important to understand the role of taxes in investing. Capital gains taxes apply when you sell investments for a profit, while dividends and interest may also be taxable. Tax-advantaged accounts like IRAs and 401ks help defer or reduce taxes, making them powerful tools for building wealth. In taxable accounts, holding investments for more than a year before selling them can qualify you for lower long-term capital gains tax rates. Being tax-aware in your investment strategy can save you money and improve your net returns over time. Robo-advisors are an excellent option for beginners who want a hands-off approach to investing. These are automated investment platforms that use algorithms to create and manage a diversified portfolio based on your risk tolerance and goals. Most robo-advisors charge lower fees than traditional advisors and offer automatic rebalancing and tax loss harvesting. They are ideal for beginners who want professional guidance without the high cost or complexity. Some of the most popular robo-advisors include Betterment, Wealthfront, and Fidelity Go. Lastly, patience is your most powerful ally in investing. The magic of compounding, earning returns on your returns, works best when given time. Even small investments grow significantly over decades. For example, investing just $100 per month with a 7% annual return can grow to over $120,000 in 30 years. Time smooths out market volatility and allows your investments to recover from downturns and flourish during upswings. The sooner you start, the more time your money has to work for you. In conclusion, starting to invest as a beginner doesn't require a finance degree, a lot of money, or perfect timing. It requires commitment, education, and a methodical approach. By building a financial foundation, setting clear goals, understanding your risk tolerance, choosing the right accounts and investments, and staying consistent, you can harness the power of investing to build wealth over time. Avoid chasing trends, stay diversified, minimize fees, and resist emotional decision-making. The most successful investors aren't the ones who know the most. They're the ones who stick with a plan, stay disciplined, and give their investments time to grow. Your future self will thank you for starting today.